Welcome back to the show. I'm Daniel Razvi.
And I'm Imran Razvi. I go by Raz.
Yes, and our company is Higher Ground Financial Group, and we focus on the three killers in retirement: risk, fees, and taxes, trying to reduce and eliminate those. Our website is riskfeestaxes.com.
And you heard correctly, we're a father-son team. Daniel is a tax attorney, so hopefully we'll get some good advice from him today.
And today we're here to talk about the volatility buffer strategy. You may have heard that term before. We've talked about it on the show in the past. The volatility buffer strategy. What is it? How does it work? And what does it solve? What kind of problem is it intended to solve?
So the problem is we know the market will go down sometimes, right? Overall, the trajectory is going up. It's going to keep going up, but there are going to be down years, and we cannot predict when the down years are. Or can we? Well, one thing I want to bring up is if you can look up or Google the Fed funds rate over the last 25 years, okay, you'll see what the federal rate has done. They kept raising rates until the dot-com bubble, when they made it too expensive for the companies to borrow money, and the dot-com bubble burst, and we had a crash. And then they lowered the rates. They kept lowering the rates until it got to the bottom, and then they started raising rates again until to the 2008 crash. They were able to crash the market then, but that was a double crash, so it lasted a little bit longer. That crash was because of the housing market and the stock market. So they kept the interest rate low for many years, and then they started raising again because they felt it was too low for too long. And then what happened? Well, COVID happened. So right before we did have a crash, but there was the shortest crash in history. It was only 1 month because the federal government decided to print $2 trillion and dump it in the market. So that brought us right out of that crash. But it caused inflation. This little word that people are hesitant to talk about, especially the government, because they don't want to give you very much in cola, right?
Yeah, so inflation has been a really big killer the last several years, and because of that, the Federal Reserve has been raising interest rates, and then they plateaued for a while, and until the market actually crashes in a big crash, then we don't expect interest rates to really drop that much, because it does feel like the Federal Reserve tries to raise them until the market crashes.
Again, my personal opinion is they'll probably raise it again because the market is not slowing down, it's not crashing, and they need to have that.
But regardless, it doesn't really matter when the market crashes happen. Even if you don't know, how can you plan for it? Well, if you have a volatility buffer, you don't need to worry about when the market's crashing. A volatility buffer is an account that's outside of the market so that when the market crashes, you don't have to take money out.
There are accounts outside the market?
There are. So why would this be important? Well, if you are saving and you're far from retirement, you're not ready for retirement yet, then market crashes don't hurt you as much as a retiree because the market is down. You're buying more because you keep investing. So
you're buying on sale.
Exactly. But when you're retired, market crashes can really kill your retirement. And
unless properly accounted for. So
yes.
It doesn't have to kill your retirement. And the thing is, if you're not prepared and the market drops when you're caught off guard, you could lose half of your retirement money. And that's why in 2008, a lot of people were saying, well, I got to go back to work. What do? I can't retire now.
Exactly. And that danger is called the sequence of returns risk. The idea that when the bad years come early in retirement, it makes it almost impossible to recover because not only is the market crashing, but you're also spending money in retirement. And so with that, the volatility buffer strategy allows you to handle and plan for those market crashes. Even if they're early on, you'll be okay because you don't have to take money out of your accounts every year in the market. So let's say you have $2 million saved and your advisor tells you, well, you can only take 3 or 4% out every year. That's because even though your investments might be getting more interest than that, you can't afford to take it out in a bad year. But if you have a volatility buffer, that means some of the money, let's say half the money, is in some other account that is not subject to market risk. That means it's contractually promised that you will not have a loss on that money. Then you can access that money when the market crashes and you won't be taking a double hit.
So that's a contract asset. So there's two different kinds of assets, contract and opinion-based.
Most of the things that you think of as assets are opinion-based assets, stocks, bonds, mutual funds.
Even your house.
Exactly. So your house is not worth what you think it's worth. It's worth what I'm willing to pay for it today.
You mean it's not my opinion, it's somebody else's opinion?
Exactly. So what you want is diversification into contractual assets that you have a contract that you know what the value is. So what are some examples? Bank accounts are a contract asset. Insurance companies, insurance products are contract assets.
So CDs and money markets, those are contracts. You're not going to have less money than what you started with, no matter what happens in the market.
And you can Google this term, volatility buffer. It's a relatively new term. The concept has been around for a long time, but the term is relatively new. Volatility buffer, there's a number of papers on it. And so the idea, if you have this volatility buffer, it allows you to spend a lot more and not run out of money. And so what examples are there of accounts that make the best type of volatility buffer? Well, the ideal volatility buffer is something that cannot lose money.
But you want to also keep pace with inflation,
Yes.
right?
So it keeps pace with inflation. You don't have to beat inflation, but you have to keep pace with inflation long term. And ideally, it will also be tax-free, so that no matter what the tax environment is, when you access this money, it'll still be able to be there for you.
So no cash under the mattress, because it's not going to grow with inflation. You got to have at least grow with inflation.
Yes. And so your strategy then is, when the market is up, take all your income that you need out of the market that year. And when the market's down, leave your market assets alone and take money out of your volatility buffer. So that volatility buffer, you need at least 6 or 7 years worth of income after taxes in that volatility buffer in order to make it work long term for you. Because if you're turning 65 today and you're going to live another 20 or 30 years, you will experience at least 5 or 6 more market downturns during your lifetime. Historically speaking, that's what happens. Every few years, there's a bad year, and you don't want to take any money out of the market in a bad year. So having that volatility buffer with a minimum 6, 7 years of strategy, the more you have, the more secure you can be. That allows you to take out almost twice as much money and never run out if you have that set up properly. So a lot of times people use a life insurance policy for volatility buffer because that often will keep pace with inflation. It can be access tax-free and so on. But maybe you are not healthy enough to qualify for life insurance, or you're getting a little late in the game. So then you can look at maybe some CDs, especially if the interest rates are very high. The CDs could be a good volatility buffer. You can still access them if you need to. But those are kind of a short-term thing.
Yeah,
so
Treasuries and CDs are great right now, but we don't know when the interest rates start dropping, you won't have that access or the growth there. And so there's only a temporary fix.
And then there are certain types of annuities that can also provide a volatility buffer help for you. And most annuities would not work for this. So you'd have to find one that is a fixed annuity that's guaranteed not to lose money.
It doesn't have fees.
And you have to have one that does not have fees, does not have riders, does not have any pension features, things like that. Those don't work so well as volatility buffer because they do not grow well generally to keep pace with inflation.
And usually if they have bells and whistles like bonuses and automatic roll-ups and stuff, you're actually losing value in some areas. So you want to be very careful when they have some bling or some catches to try to get you to buy that annuity. Investigate what are you giving up when you get that bonus.
And there's a lot of different things you could use for a volatility buffer, but if you want to look for something that will not go backwards if the market crashes, it has no fees, it will get interest, hopefully at least to keep pace with or beat inflation. And if you get more interest, that's even better. And then if you can make it tax-free, that's the best. Now you might think, well, if it's an annuity, how can it be tax-free? Or if it's a CD, how can it be tax-free? Well, if it's a Roth IRA, then it could be tax-free.
Yeah. And if you did not put money into a Roth, but you have an IRA, you can always convert to Roth. We'll talk about that some other time, but there's no limitation so long as you follow some rules. There's a 5-year rule, and there's some other things you want to be aware of. But you can convert no matter how much money you make. You can convert to Roth. But we had a client just last week who thought that he had a good volatility buffer. He had a bunch of gold and silver in his house, and so I asked him. I said, "Okay, when's the last time you bought something with gold?" Yes, dead silence. He had never bought anything in gold because nobody takes gold for a payment. So gold and silver, yeah, and it's also gold and silver is a market opinion based asset because it could lose value or gain value, and you're not in control of that. Although it may be a little bit safer because it is an actual physical metal. The problem is, how do you sell it? You'd have to find somebody else to buy it and then convert it to money, and
it'd be whatever they're willing to pay for it at the time. And what we've seen in recent years is there's so many gold hedge funds that a lot of times when the market's crashing, the gold is also being affected. So what you need is an asset that is contractually set what your value is, and that it will not go below a certain amount. So when you if you want to find more out about what we can do for you, you want to go to our website, riskfeestaxes.com. Again, that's riskfeestaxes.com. We can schedule a free Zoom call with you. So it's a video call. We do not do in-person meetings here at Higher Ground. But if you go to riskfeestaxes.com, we'll be able to talk to you for 15 minutes and you can find out how we can help you, and we'll know whether or not we can help you.
Yeah. And even a fixed interest rate loan credit line can be used as a volatility buffer if you have enough and and it can't change because you can control it. It's a contract.
If you know that the bank cannot close it on you. So
Correct.
We had a client also back in 2009, 2010 timeframe where he had a
$200,000 credit line that was there for emergencies and he would never been late. His credit score was 800, no problems, no issues.
And the bank said, well, the housing market's crashed, and so we think we need to take some risk off the table, so we're going to close this line for you. So that was his volatility buffer, and he had no other option. And so when he came to us, he said, look, this is not working out. We need to find something else that I can use as a volatility buffer.
Right.
Because this was happening before he became our client. So there's a number of different strategies. Most of the most efficient strategies are going to be something that's insurance based if it has some kind of guarantee by the insurance company. And that's going to be obviously based on what the claims paying ability of the insurance company. So you need to pick a strong one that's A-rated and all that.
Usually. And Daniel, you mentioned life insurance before earlier. So life insurance, people think there's a lot of different kinds of life insurance. I may have life insurance at work. Is that good?
It won't help for a volatility buffer. It's good to have life insurance if you're working, so you can be replacing your income if you pass away. But a specific type of life insurance for a volatility buffer has to be something that's fixed, and it's a cash value policy that you are maxing out. So there is the maximum the IRS allows for that policy, and that's what allows it to grow hopefully better than inflation over the long term.
Yeah, so cash value policy has a lot of variables in it, and you want to make sure if you're max funding it, meaning the most the IRS will allow, because that's how that cash value will grow and allow you to use it.
Most people want to pay as little as possible for the life insurance.
Right.
And that's great if the death benefit is the only reason. But if you want to use it as a volatility buffer, you need to actually pay as much as you possibly can for the life insurance until the IRS shuts it off and says you can't.
Wow, that kind of rocks your world, right? Want to pay more than what they're asking for.
So there's a lot of different things with the volatility buffer, but the key is find something that's outside the market. And I'm not saying to get rid of the market entirely. You're going to want to have some money in the market because certain years the market will do really well. But it's the years that the market crashes that you need somewhere else that you can take money out of to meet your lifestyle. And so that's what the volatility buffer is. So again, go to our website, riskfeestaxes.com, and we'll schedule a free video call with you to talk to you about what's the best thing for you.
And if this seems confusing, that's all right. It's confusing to a lot of people, and that's why we're here. And if you don't know what is the best volatility buffer for you, that's why make the appointment. Go to riskfeestaxes.com, make an appointment. It's free, doesn't cost you anything. We can take a look at your situation, and as fiduciaries on a call, we would actually always act in your best interest. This is a radio show, so we don't know what your situation is. This is just general information.